Hey everyone, and welcome back to the show. Today we're diving deep into a topic that might seem a little dry at first, but trust me, it's way more interesting and important than you might think.
I think a lot of people kind of tune out when they hear the word inflation, but it
Right.
really is something that affects all of us.
It's like this silent force that's constantly at play in the background, shaping our financial lives, right?
Absolutely. By the end of this deep dive, I guarantee you'll have a whole new appreciation for inflation and how it impacts everything from the price of your morning coffee to your long-term savings goals.
Love that. And speaking of savings goals, we've got some really eye-opening sources lined up for this deep dive. Like, did you know that even if you're getting a raise every year, inflation could still be making you poorer?
Yeah, it's one of those sneaky things that can really chip away at your purchasing power over time.
Exactly. And we'll be unpacking all that and so much more, like how a booming economy can sometimes be the very thing that drives prices up, or how just the expectation that prices will rise can actually become a self-fulfilling prophecy.
We'll break down the different types of inflation, explore the forces that cause it, and dive into how it's measured.
Because you can't really tackle a problem until you understand how to track it, right?
Exactly. And perhaps most importantly, we'll connect all of this back to your everyday life, how inflation impacts your budget, your investments, even your career decisions.
So let's get right to it. Before we get into the nitty-gritty, can you give us that, like, explain it to my grandma definition of inflation?
Okay, so at its most basic level, inflation is a sustained increase in the general price level of goods and services in an economy over a period of time.
Okay, so in plain English, that means things are getting more expensive.
Yeah, pretty much. And the key takeaway there is that when prices rise, the purchasing power of your money decreases.
So, like, if a loaf of bread cost $2 last year and now it costs $2.50, that's inflation eating away at my bread budget.
Exactly. It might seem small on an individual item, but imagine that happening across everything you buy: groceries, gas, rent.
Oof. Yeah, suddenly that small change starts to feel a lot bigger.
Right. And it's not just about individual items. It's about the overall erosion of your purchasing power.
So, how do we even begin to measure something as complex as inflation? Our sources mention something called the Consumer Price Index, or CPI. What's that all about?
So the CPI is basically a way for economists to track the average change in prices paid by urban consumers for a basket of consumer goods and services.
So, they take a bunch of everyday things that people buy, like food, clothes, transportation, and see how much the prices of those things change over time.
Exactly. It's like a snapshot of how much more or less expensive it is to buy that same basket of goods from one month to the next.
So if the CPI goes up 2%, does that mean literally everything in that basket is now 2% more expensive?
Not necessarily. It's an average, so some things might have gone up more, some less, and some might have even stayed the same or gone down.
Okay, so it's a broad measure, not hyper-specific to each item.
Right, but it gives us a good overall sense of how inflation is trending.
Got it. Now, there's another index mentioned in our sources, the PPI. What's the difference between the CPI and the PPI?
So the Producer Price Index, or PPI, measures the average change over time in the selling prices received by domestic producers for their output.
So instead of looking at what consumers are paying, it's looking at what businesses are paying for the things they use to make stuff.
Exactly. It tracks changes in prices for things like raw materials, energy, and intermediate goods.
Okay, so if the PPI goes up, does that mean we can expect the CPI to go up soon after, like a chain reaction?
It can be a leading indicator, yeah, because if producers were paying more for their inputs, those costs are often passed along to consumers in the form of higher prices.
Makes sense. Now, I've also heard economists talk about something called core CPI. What is that and why is it important?
So core CPI is a measure of inflation that excludes volatile food and energy prices.
Ah, so it's like the CPI, but without the things that tend to jump around in price a lot.
Right. Food and energy prices can fluctuate a lot due to things like weather events or global supply disruptions. So excluding them gives us a more stable, long-term view of underlying inflation trends.
Okay, I get it. It's like trying to see the forest for the trees. You want to filter out the noise and focus on the big picture.
Exactly. Now that we have a handle on how we measure inflation, let's get to the juicy part: what actually causes prices to rise in the first place.
Right, because it can't just be random. There have to be some underlying forces at play, right?
Right, and our sources highlight two main categories of inflation: demand pull and cost push.
Ooh, okay. Those sound intriguing. Let's break them down one by one. What's the story with demand pull inflation?
Demand pull inflation is essentially too much money chasing too few goods.
So like when everyone wants the latest iPhone and they're flying off the shelves faster than Apple can make them?
Exactly. You have high demand and limited supply, which drives up prices.
Got it. So that's demand pull, too much demand pulling prices up. Now, what about cost push inflation? What's pushing those costs up in that scenario?
Cost push inflation happens when the costs of production increase.
So like if the price of oil goes up and it costs more to make and transport goods, those costs are passed along to the consumer.
That's a perfect example. Other factors that can contribute to cost push inflation are things like rising wages, supply chain disruptions, increased taxes.
Our sources dive into some specific examples like the pandemic's impact on supply chain.
Oh yeah, that was a big one. Suddenly there were shortages of everything, and the cost of shipping goods skyrocketed.
And those increased costs get passed down the line, eventually landing on the consumer's shoulders.
It's like a domino effect. One price increase leads to another.
Wow, so many interconnected pieces to this puzzle. But it's not just economic factors at play, right? Our sources also mention the impact of things like natural disasters and geopolitical instability.
Right, those can have a huge impact on prices too. Think about what happens to gas prices when there's a hurricane in the Gulf of Mexico or a conflict in a major oil-producing country.
It's like a ripple effect. Even events happening on the other side of the world can impact prices here at home.
Absolutely. And here's another interesting wrinkle. Our expectations about future inflation can actually make it worse.
Wait, really? How does that work?
It's a bit of a self-fulfilling prophecy. If businesses and consumers believe prices are going to rise, they start acting in ways that actually make it happen.
So if everyone thinks prices are going up, they rush out to buy things now before they get even more expensive, which further increases demand and drives prices up even more.
Exactly. It's a fascinating interplay between psychology and economics.
Okay, so we've defined inflation, looked at how it's measured, and even explored some of its root causes. But how does this all play out in our day-to-day lives? How does inflation impact the average person trying to make ends meet, pay their bills, and maybe even save for the future? That's what we'll unpack in part 2. All right, welcome back to the show. So we've talked about what inflation is, how it's measured, what causes it. Now let's get real about how it affects, our lives like day to day, like when we're at the store or paying bills.
Yeah, that's where the rubber meets the road, right? It's one thing to understand inflation in theory,
Totally.
but it's another to actually see how it plays out in your bank account.
Exactly. Our sources mentioned some tips for dealing with this whole inflation thing. One that stood out was making your savings work harder.
Oh yeah, that's key.
Hmm.
See, when inflation is high, just stashing your cash in a regular savings account might not be enough.
Because the interest you're earning is probably lower than the rate of inflation.
Exactly. Your money is actually losing value even though it's technically saved.
Ouch. So what's the move then? Where do we put our money so it doesn't, just shrink away?
You got to find those savings vehicles that offer returns that can, beat inflation.
Like what?
Like high-yield savings accounts, money market accounts, maybe even short-term CDs.
So shop around, compare interest rates, basically be a savvy saver.
Exactly. Oh, and another thing you might look into, Treasury inflation-protected securities.
TIP EC. I think I've heard of those.
Ever invested in them?
Can't say I have, actually. What makes them different from, say, a regular bond?
So with TIP PS, the principal value adjusts to inflation. As the CPI goes up, the value of your TIP PS goes up too.
So it's kind of like a built-in inflation shield for your investment.
You got it. It helps protect your purchasing power over the long haul. Of course, TIP PS might have lower returns than regular bonds if inflation is low.
Right, there's always a trade-off. Now, what about the stock market? How does inflation play into all that?
Well, inflation can be a tricky one for investors. It can erode the value of future returns.
Meaning your investments might not grow as fast as you need them to reach your goals.
Right. But on the flip side, some companies actually do well when there's inflation.
Okay, that's interesting. What kind of companies?
Usually companies that can raise prices without, losing customers. Companies with strong brands, those that provide essential stuff.
So things people need no matter what, even if the price goes up.
Exactly. And also growth companies. They have the potential to, outrun inflation with their earnings.
So their stock prices keep climbing, even with inflation.
You got it. It's all about diversification, though. Don't put all your eggs in one basket.
Spread the risk, right. Invest in different types of assets like stocks, bonds, real estate.
Right. Build that portfolio that can handle different, economic weather.
Storms, exactly. But let's face it, for a lot of people, dealing with inflation isn't about fancy investments. It's about, paying the bills.
Keeping your head above water.
Right. We talked earlier about how even with raises, you might not be keeping up with rising prices. What's the advice for, folks in that situation?
Well, one of the most important things is to know your worth.
Easier said than done, right?
It's about doing your research, find out what people in your field, with your experience, are making in your area.
So you're armed with information when you go into a salary negotiation.
Exactly. And don't be afraid to ask for what you deserve, especially when inflation is, eroding your buying power.
Be your own advocate. Now, debt. How does inflation affect things like mortgages, loans, credit cards?
Okay, so here's where it gets a little tricky. If you have fixed rate debt, like a mortgage with a set interest rate,
Yeah.
inflation can actually work in your favor.
Wait, really? How does that work?
Think about it. The value of the money you're using to pay back that debt is decreasing.
So you're basically paying back the loan with cheaper dollars.
You got it. But that only applies to fixed rate debt. Variable rate debt, like credit cards, that's a different story.
Yeah, those interest rates can go up, making it harder to pay off what you owe.
It's like running on a treadmill that keeps getting faster.
So pay down that high interest debt ASAP, especially when inflation is up.
Absolutely. And another thing, don't forget about being a smart consumer.
What do you mean by that?
Just being mindful of your spending. Find those little ways to save money every day.
Like what? Give us some examples.
Could you bike to work a few days a week instead of driving? Are there cheaper grocery stores in your area? Maybe cut back on those streaming services you're not really using.
The little things add up. Okay, now before we move on to the final part of our deep dive, I want to touch on financial advisors.
Oh yeah, they can be a huge help, especially when things are, uncertain like they are now with inflation.
Right. But how can they help the average person deal with all this? What do they bring to the table?
And we're back for the final part of our deep dive into all things inflation.
Phew. Yeah, we've covered a lot of ground. From, the basics of what inflation is to some pretty in-depth strategies for dealing with it. Totally. So as we wrap up, let's try to distill some key takeaways, something our listeners can walk away with and actually use.
For me, one of the biggest things is just realizing that, inflation isn't just some abstract economic theory.
It's real life.
Exactly. It's hitting our wallets every single day, whether we realize it or not.
And, as they say, knowledge is power, right? The more we understand about inflation, the better decisions we can make.
Right, from how we spend our money to how we save it and invest it.
Exactly. And we've talked about a bunch of different strategies like finding those high-yield savings accounts, diversifying our investments, even, getting that raise we deserve.
And just being smart about our spending habits in general, being a mindful consumer.
Being aware of where our money is going, making conscious choices.
It all adds up.
It really does. Now, before we sign off, you mentioned financial advisors earlier and how they can be helpful.
Oh, yeah, big time, especially with all this, economic uncertainty we're facing.
But how can they actually help? I mean, what can a financial advisor do for the average person?
Well, a good financial advisor can, really tailor their advice to your specific situation, your goals, your risk tolerance.
So it's not just one-size-fits-all advice.
Definitely not.
Yep.
They can help you build a plan that takes inflation into account and keeps you on track to, reach your financial goals.
So like a financial coach, but personalized.
Exactly. And they can offer that expertise and, a steady hand to help you navigate those choppy economic waters.
Love that analogy. Now, before we wrap things up completely, I wanted to throw out a question that wasn't explicitly covered in our source material, just something to think about.
Okay, I like where this is going.
So we've talked a lot about the downsides of inflation, but is there ever a situation where, a little bit of inflation could actually be a good thing?
That's an interesting one. Some economists would argue that a small amount of inflation can actually be a sign of a healthy economy.
Really? How so?
Well, think about it. If people expect prices to go up in the future, they might be more likely to spend and invest now.
Makes sense. Why wait if it's just going to cost more later?
Right. And that increased spending and investment can stimulate the economy, lead to job growth, that kind of thing.
So it's like a little push to keep the economic engine running.
Yeah, exactly. And for businesses, a little inflation can actually make it easier to adjust wages and prices, which can lead to a more flexible and responsive economy.
So not all inflation is created equal.
Definitely not. It's all about finding that balance, that sweet spot where there's enough inflation to encourage growth, but not so much that it becomes, a major problem.
Makes you think. It's like that old saying, too much of a good thing can be bad.
Words to live by.
Well said. I think that's a perfect note to end on. We've really explored inflation from all angles, but the conversation doesn't have to end here. Keep learning, stay informed, and make those smart financial decisions.
Knowledge is power, especially when it comes to your money.
Couldn't agree more. Thanks for joining us for this deep dive into inflation. We'll catch you next time on The Deep Dive.